Hello and welcome to this session. This is Professor Farhat, in which we will discuss bond yield plus risk premium. And this is a way to do what? To estimate the required rate of return or the cost of retained earnings. Hold on a second. Didn't we discuss this topic earlier? Yes, we did. There are many ways to estimate the required rate of return or the cost of retained earning. We did so through the discounted cash flow, and we did so through the CAPM. So what does that mean? It means this is another method to estimate the required rate of return using the bond yield plus a premium. This method provides an estimate of a company's cost of retained earnings or the required rate of return by building upon the known cost of debt. The cost of debt is known. In what sense? When you borrow money, you know how much you are paying for that. You know how much it's costing you. Then we're going to start with that and adjust it upward. Then we're going to add some sort of a risk premium. That's why it's called bond yield plus risk premium, to figure out what should be your cost of capital. Now, what do we know about this method, or what do we need to know? Well, it's simple and clear. It clearly distinguishes between the known cost of debt and the additional risk associated with equity. Now, that additional risk in the real world, you have to estimate. Now, how would you estimate? Again, depending on the industry, growth, and other factors. But it's a realistic representation of what's happening. It ties the cost of equity to an observable market rate, which is the bond yield, making it straightforward to apply, because the bond yield is usually known, how much you are paying for your long-term debt. And it's useful in practice, especially when you don't have information on the dividend growth or the dividend of the company. Let's assume the company don't pay dividend. We have no information about the beta value that we use for the CAPM and the dividend growth for the DCF, and uncertain or challenging to determine the reliability. Therefore, it's a practical and easy way to compute the required rate of return or the cost of retained earnings. Let's go ahead and dive deeper into the computation, the limitation. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course, such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Starting with the formula, well, the cost of retained earning, or simply put, how to compute R, you will take the pre-tax cost before the cost of long-term debt, before you factor the tax, and you add to it the market risk premium. So what's the pre-cost of long-term debt? It represents what we call the yield to maturity on the firm's long-term debt. How much it's costing you to borrow long-term debt. It serves as the base, reflecting the firm's baseline risk and borrowing costs. So that's the base. Then what we do, we add this risk premium. What's that risk premium? This is the additional return that the equity investors wants to earn for bearing the higher risk associated with equity compared to debt. Now, what am I saying here? What I'm saying is I'm implying that debt has a lower risk than equity, and I hope you know this. If you invest in a bonds, you have a lower risk than equity, but because you have a lower risk, you have a lower rate of return. So we will start with your debt rate of return, with your long-term debt, and we'll add to it some sort of a risk premium. Let's take a look at this example to illustrate the computation. XYZ Corporation wants to estimate its cost of retained earnings, or same thing as the cost of capital. The company has determined that the current yield to maturity on its long-term debt corporate bond is 8.75. Also, financial analysts estimate, notice it's estimate, that the market risk premium for equity investment in XYZ is 5.25. Well, let's first do the computation. Let's compute the bond yield plus risk premium. You already know the bond yield, which is 8.75. We add the risk premium, 5.25. Then we combine them together and we'll get 14%, which is 8.75 plus 5.25. What does that mean? It means the cost to keep the money is 14%. It means the company has to earn at least 14% internally Otherwise, the investors want their money because 14% is the cost of retained earning based on this information. Let's take a look at this multiple choice question from farhatlectures.com. What is the cost of retained earnings for Morgan Enterprise using the bond yield risk premium method? So Morgan Enterprise has a pre-tax cost of debt of 9% and a market risk premium of 4%. I mean, come on. The method is called bond yield risk premium, bond yield plus risk premium. So if I take the bond yield plus the risk premium, I will get 13%. So it's basically self-explanatory, but it's very important to understand what? To understand that the long-term debt is your baseline, just like the risk-free rate in CAPM is your baseline. Then you add to that baseline. What do you add? You would add the market risk premium that you estimate. In a sense, the same concept, and it's serving the same thing as CAPM. It's serving the same thing as discounted cash flow, but using long-term debt. What should you do now? You want to go to Farhat Lectures, whether you are a student, a CPA, CMA, CFA candidate, invest in yourself. Farhatlectures.com will provide additional resources. Good luck and stay safe.